It is that time to dive into our afternoon lesson on SMAs, simple moving averages, and EMAs, exponential moving averages. We all use them, right? I'm pretty sure every single person uses at least one EMA intraday and probably 2 to 3 SMAs on the daily chart. But what's the difference between an SMA and an EMA, right? They're both moving averages. They're both based on the last 10 periods, 20 periods, 200 periods, right? But what's really the difference between an SMA, a simple moving average, and an EMA, an exponential moving average? Really, to keep it very simple, guys, the only difference between an SMA and an EMA is how they're weighted. It's just the formula on how they're weighted against the last set periods. So when we think of a 9 EMA, right, it is a 9-period exponential moving average. So it takes the last 9 periods and takes the average and it plots it, right? So over the last 9 periods, so if you're looking at a 1-minute chart, it's going to be the last 9 1-minute candles. If you're on a 5-minute chart, it's going to be the last 9 5-minute candles. That's a 9 EMA, right? We could always throw the word period in there. It's taking the last 9 periods if it's a 9, right? If it's a 20 EMA, that is a 20-period exponential moving average. So it's taking the last 20 1-minute candles and factoring what the average was between the open and the close, right? If you're on a 5-minute chart, right, you're looking at the last 20 5-minute candles. So here's what I want to clarify before we dive into the exact definitions. You've heard me say a lot, the 200 SMA, the 50 SMA on the daily chart, right? Those are the top, most popular moving averages that nearly every investor and every trader utilizes. The 200 simple moving average and the 50 simple moving average. If you take the 200-day moving average and the 50-day moving average and apply it to a 4-hour chart, it is not a 200-day moving average. It is not a 50-day moving average. Right now on my daily chart, my red line is my 200-day moving average. My blue line is my 50-day moving average. The second that I go from day to 4 hours, this is no longer my 200-day moving average. That is a 200-period moving average. So what is that doing? It's taking a period, and I'm on a 4-hour chart, so that's a 4-hour candle. It's taking the last 200 4-hour candlesticks and generating the average, and it's plotting that on my chart. So that's a 200-period moving average because I'm on a 4-hour chart. If I go to a 1-hour chart, same thing. It's not a 200 SMA, right? It's not, because we're not on a daily chart. It's only a 200-day moving average when we're looking at it on the daily chart. It's only a 50-day moving average when we're looking at it on the daily chart. But when we go to a 1-hour chart, let's just keep it simple. It's a period. So it's a 200-period moving average, taking the last 200 candles, no matter what time frame you're on. If it's a 1-hour chart, it's taking the last 200 1-hour candles. If you're on a 30-minute chart, it's taking the last 200 30-minute candles. Right? So I wanted to clarify that because there has been some confusion in the past. Like, Josh, I'm looking at the 200-day moving average on the 1-minute chart. It's not a 200-day moving average on the 1-hour chart or on the 1-minute chart. It would be a 200-period moving average on the chart, right? So it'd be the last 200 1-minute candles. So let's go ahead and get that out of the way, and let's go ahead and really break that down, right? The only reason it's a 200-day moving average because it's on the daily chart. The only reason it's a 50-day moving average because it's on the daily chart. But when you start changing the time frames, right, you can no longer call it a 200-day moving average, right? You're going to confuse yourself. It's a period. And if you want to keep it simple, even on the daily chart, it's a 200-period moving average. It's taking the last 200 days and giving you an average, right? And we just say it's a 200-day moving average, right? You're not going to say it's a 204-hour moving average. It's not a 230-minute moving average. I mean, it just sounds weird when you say it that way. It would be period, right? So we know exactly really what the difference between an SMA and an EMA is. An SMA is a simple moving average, and EMA is an exponential moving average, right? And basically, the only difference is the way that they're weighted, the way that the formula is set up. So a simple moving average, SMA, calculates the average of a selected range, right, your time frame, of prices, usually closing prices, by the number of periods in that range. So your range is, right, so calculates the average of a selected range of prices. So again, if you have a 200 SMA, it's looking at the last 200 days of closing prices by the number of periods. So again, 200, right? The last 200 closing prices, it's going to populate the average. It's very simple what a simple moving average is. So a simple moving average calculates the average of a selected range of prices, normally the closing prices, by the number of periods in that range. A simple moving average is a technical indicator that can aid in determining if an asset price will continue or if it will reverse or a bull or bear trend and form a bull or bear trend. A simple moving average can be enhanced as an exponential moving average that is more heavily weighted on recent price action. So a 200 SMA and a 200 EMA, right? They're still 200 period moving averages, but they're going to be plotted differently on the chart based on the weight, how they're formulated, right? So a simple moving average is an arithmetic moving average calculated by adding recent prices, then dividing that figure by the number of time periods in the calculation average. So for example, one could add the closing price of a security for a number of time periods, then divide this total by that same number of periods. Short-term averages respond quickly to changes in price of the underlying security, while long-term averages, 200, are slower to react. There are other types of moving averages, including the EMA and the weighted moving average, the WMA. Not very popular. The popular ones are SMAs and EMAs. But again, here's a formula if you want to know, right? And again, the formula, basically what this says and what we know is taking the last 200 closing prices, adding them all up and dividing it by the number of periods, and that's going to give you the average closing price of any given security. It's going to plot that on the chart for you. And why are we using SMAs? They're popular, guys. They're popular, right? For every 100 traders in the market, I guarantee 90 of the 100 are using a 200-day moving average on their chart, a 50-day moving average on their chart, and or a 13 simple moving average or a 20 exponential moving average. So again, almost every trader and investor is using a 200-day, a 50-day, and then either a 13-day moving average or a 20 exponential moving average on the daily chart. Those are the three most popular SMAs and EMAs that traders and investors use on daily charts. So why do we use them? Because they're popular. Everybody else uses them. The stock comes down to the 200 SMA, it bounces. Why? Why is it bouncing? Because it's a moving level of support, right? It's a moving level of resistance. How many times have you seen a penny stock run up to the 200-day moving average and then just sell off? Well, because 90% of day traders see the 200 simple moving average as one of the strongest lines to break, right? So when it runs up to the 200 SMA, traders are like, shit, it's going to be pretty hard to get above this level because it's a strong level of resistance. Let's take profit. That's what causes the stock to move back down. Same thing when the stock's overextended, far away from, say, that 200 simple moving average, and it starts pulling back to the 200 SMA. Why does it bounce? Why does it move back up off that level? Because traders see that as a strong level of support. So they buy around that level, which causes the stock to bounce, to start to move back up. So again, we use them because they're very, very popular. 90% of traders and investors use simple moving averages. A lot of people use exponential moving averages on their intraday charts, right? Like the 9 EMA, the 20 EMA. And how do they use them, right? We know why we're using them because they're popular, but how do we use them? We use them as a moving level of support and resistance. To keep it that simple, it's a moving lagging indicator. It is lagging. It lags, right? and it's a moving line. It's not a stationary line like a trend line. It's set, it's fixed. It's not a level of support where it's fixed. It moves, but traders utilize it as a moving level of support and resistance. So we know why we're using it, and we know how we're using it as well, right? So again, now understanding the EMA, understanding an SMA, now it's which ones do we use, right? Which ones are popular and how are other traders using them? Well, we just talked about SMAs, right? We know that 90% of traders are using a 200 SMA on the daily chart. That's a given. 90% of traders are using a 50 SMA on their daily chart. That's a given. But here's the 50-50. A lot of traders use a 13 simple moving average, and a lot of traders use a 20 exponential moving average on the daily chart. There's no right or wrong. The 13 SMA, very popular. The 20 EMA is very popular. For the longest time, for the last 3 years, I've used a 13 SMA. But here recently, I've seen that the 20 EMA has become very, very popular. And a lot of people are transitioning from a 13 SMA to a 20 EMA. So if there's more traders, abandoning the 13 SMA and going to a 20 EMA, which one do you think is going to be the most respected, the most honored, the most validated, the one that the majority is using for their charting, for their technical analysis? So I've been seeing a lot of traders more or less talking about the 20 EMA as being one of the more popular moving averages for the daily chart. So I took the 13 SMA away, and I'm now using a 20 EMA. But there's no right or wrong. You can use a 13 SMA and a 20 EMA. You can use a 13 SMA, and that's it. Or you can just use a 20 EMA, and that's okay. My personal preference, right, is the 20 EMA, along with the 50 SMA and the 200 SMA on the daily chart. So that's what I use on the daily chart, and why I'm using them, and how I'm using them, right? Now, there's some extra strategies behind, crosses, right? If a 50 crosses the 200 to the downside or to the upside, there's certain terms. You've heard like maybe the death cross, the golden cross, etc., right? It gives you an idea of where the market's heading, right? So again, we'll talk about there in a second. So we talked about SMAs. Let's talk about EMAs. So an exponential moving average, an EMA, is a type of moving average that places greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponentially weighted moving average. An exponentially weighted moving average reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in that period. So the SMA moves slower. The EMA moves faster, right? Not as far as plotting, but as far as to the current price. So the SMA is going to be normally a little bit farther away. The EMA is going to be a little bit closer to the price because it's being weighted differently, right? There's a heavier weight being placed on an EMA. So that's why it's ideal to use EMAs intraday on your 1 minute, 2, 3, 5, 15, 30-minute charts. And again, why are we using EMAs, not SMAs? Let's really just keep it simple. Psychology, guys. Because the vast majority of traders don't use SMAs intraday. 1 minute, 2 minute, 3 minute, 5 minute charts. What are they using? They're using EMAs. Why? Because it's going to move closer to current price. And when you're day trading, that works a little bit better, right? Absolutely. So why did traders resort and really just all use EMAs? Because again, there's a reason behind it. It's going to move a little bit closer to the most recent points, right? Those periods. So again, it's all popularity as well. For every 100 traders in the market, 90 of them are at least using one EMA, right? They're either going to be using a 9 EMA, or they're going to be using a 20 EMA, right? Those are the most popular exponential moving averages that traders use intraday, right? Is a 20 EMA and it's a 9 EMA. So it's a 9 EMA and a 20 EMA. Sorry, I got thrown off with the phone call. So those are the most popular ones, and it's the same thing, right? How do we use them? As a moving level of support and resistance. That's how other traders use them. That's how we use them, right? So when the stock rips to the upside, right? When the stock rips to the upside, breaks over the 9 EMA, and it pulls back. Why does it bounce off the 9 EMA? Because traders buy when the stock comes back down to the 9 EMA, which creates the bounce. So again, traders utilize the EMAs, right, the 9 and the 20, the most popular, as moving levels of support and resistance. Now, there's other somewhat popular EMAs that traders use. I've seen traders use a 50 EMA, a 100 EMA, a 150 and a 2 and a 250 and a 3, right? And they have all these EMAs plotted on the chart. And basically what they do is when the stock comes down to an EMA, they scale in. If it comes down to another EMA, they scale in. And that's all they do is anytime the stock, after it broke out, pulls back to an EMA, they take a little bit of a position. They're accumulating with the expectation that the stock never drop below the 200 EMA. So they'll accumulate at the 9, the 20, the 50, the 100, the 150, and the 200 with the expectation of getting a nice cost basis brought down, the stock never dropping below the 200 EMA, that if it's a hot stock, it's a stock that's in a nice trend, and the EMAs are still pointing to the upside, looking for the curl, looking for the momentum to move back in. So there are certain types of techniques and strategies, I guess, behind just averaging in off the EMAs. But again, that's a one indicator reasoning, right? The stock coming down to the 9 EMA is only one reason to enter a trade. The stock coming down to a 20 EMA is only one reason to enter a trade. So they really have a one reason approach. Scale, 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 with the hopes and the expectations of the stock not dropping below the 200 and pushing back up with momentum. I'm not a fan of that. I'm not a fan of taking trades based on one reason. We find 2, 3, 4, as many separate reasons as possible to enter a trade, right? So at least we know which ones are the most popular. The 9 EMA, 20 EMA. How traders utilize the EMAs intraday, right? Moving levels of support and resistance. And there are certain approaches and strategies behind utilizing EMAs. What's one thing that I've talked about a lot since we've been live in chat? Hey guys, watch this ticker for the 9 EMA VWAP cross. So when the stock is selling off, it regains the 9 EMA as support, and we see the stock getting tight between VWAP resistance and 9 EMA support. When you normally see that squeeze, right? You get squeezed between 9 EMA support and VWAP resistance, and those two levels cross, you usually see a lot of hype and a lot of volume move back in, and that's kind of what you're seeing on AMD. The stock getting destroyed below VWAP, getting destroyed. Look at AMD, guys. Look at how many times this was respected as a level of resistance or support. So look at this. Resistance. Right there. Resistance. Right there. Support. Right there. Resistance. Resistance. Right? Now look, that we're above. Support. If it pulls back to the 9 EMA, what would you think would happen? Traders probably come in and buy it as support. And right now you're seeing the stock break the VWAP. The 9 EMA is starting to cross the VWAP. Typically when that happens, you get a nice solid uptrend move and the stock continues the trend higher. When your short-term EMA crosses over the volume weighted average price, the VWAP. Same thing, when you have a 9 and a 20 EMA cross back above the VWAP, 80% of the time, the stock will continue the trend higher. So that's an approach. I've talked about that a lot. Hey, look for the 9 EMA VWAP squeeze. The stock will get so tight between those levels and pop, right? 80% of the time, it'll pop above resistance and squeeze to the upside. Or when you have a 9 and a 20 EMA crossing back above the VWAP, that's telling you that your shorter term moving averages are crossing back above the volume weighted average price, right? The average price based on volume. That's a sign of bullishness as well. So that's one way you can use it, right? Is looking at the 9 and the 20 crossing above or below the VWAP, right? Both of those crossing above the VWAP is a sign of bullishness, right? Traders think that's a sign that the stock is going to continue the trend higher, right? And when those two EMAs cross below the VWAP, that's an indication that the stock is going to continue the trend lower, right? So that's an approach, right? Do I use that all the time? No, I like seeing the squeezes, right? So I'm a big squeeze fan. So when you see a stock, right, so this gray line is going to be your VWAP. And let's say the stock is just selling off, right? It's selling off. And you have your beautiful 9 EMA, right? You got your beautiful 9 EMA just holding the stock down as resistance, right? The stock, it's getting tagged as resistance, selling off. And then you see it start to pop back above the 9 EMA, right? Now you start to see that 9 EMA start to curl back up as well. So now the stock is above the 9 EMA, and let's say it's just grinding above. And every now and then you'll see the stock getting tight between the VWAP as resistance, and you'll see that 9 EMA trying to hold the stock up as support. And that's a squeeze formation, right? You have the 9 EMA holding the stock up as support. You have the VWAP holding the stock down as resistance. That's a good 80-20 setup, right? When you have the stock back above the 9 EMA trying to break the VWAP, that's a great squeeze setup. 80% of the time, you will see the stock get very tight and squeeze over the VWAP. And that 9 EMA will then cross the VWAP as well. And 80% of the time, you see that stock trend higher, right? How many times have you seen a 9 EMA VWAP squeeze followed by the 9 EMA crossing the VWAP and the stock just consistently trend higher the rest of the day? It happens a lot. I like the squeezes on higher time frames. So my personal preference is seeing that type of squeeze, that kind of setup, that confirmation on a 5-minute time frame. Gives me more confirmation that that's a good higher time frame squeeze, a good higher time frame setup versus on a 1 minute, right? The 1 minute seems to be a little choppy sometimes. The 5 minute is really clear, really clean, and it allows you to be extra patient and wait for that confirmation of that 9 crossing the VWAP and seeing that stock trend higher, not for the rest of the day, but for a good while, right? So with that being said, there's some strategies. You know, you have a 9 EMA VWAP squeeze intraday, right? When the 9 EMA crosses the VWAP, traders consider that to be bullish, that we can continue to trend higher, right? What's another one? The first 9 EMA pullback, and we saw that on AMD. When the stock breaks above the 9 EMA intraday, and it rips to the upside on high volume, right? Like AMD did. Stock is below the 9 EMA. Stock broke above here, ripped, right? Now it's starting to pull back. Traders that utilize the 9 EMA will do what's called a first 9 EMA pullback approach, where the stock rips and breaks over the 9 EMA, becomes overextended, and the stock starts to pull back to the 9 EMA. Traders will look to buy the pullback off the 9 EMA for the next leg up on the first time, on the first pullback. Now, I've seen the stock pull back, rip, pull back the second time, rip again, and then it becomes risky. So I would say the first 9 EMA pullback or the second 9 EMA pullback. The third one, the fourth one, the fifth one, I would personally not be trading the 9 EMA pullback strategy as a standalone, anything after 2. So again, traders were literally as a standalone buy, as a standalone indicator to get long, the first 9 EMA pullback and the second 9 EMA pullback as a standalone indicator to get long for the next leg up without having any other separate reasons. Now with really volatile, really low float, quick moving, low price stocks, right? When the stock breaks and rips and screams to the upside and it starts pulling back, how many times have you seen that stock pull back to the 9 EMA for the first time and then boom, rip right away and shoot in the new intraday highs? Happens a lot, happens all the time, right? So again, there is a strategy and there is an approach behind utilizing the 9 EMA intraday, right? The first pullback to the 9 EMA, you have pretty good odds of that stock holding and getting that next leg up, right? The second one, you have good odds, but they're not like 80-20 odds, maybe like 60-40, 70-30 odds. Anything after the second one, it becomes 50-50, right? Anytime you notice a stock rip and pull back, 0.1, it pushes again, pulls back, 0.2 and pushes. Usually after that second push, it starts becoming really, really risky and you start to see that 9 EMA crack. So like AMD, broke the 9 EMA, ripped to the upside, pulled back to the 9 EMA, bounced, ripped, pulled back to the 9 EMA, bounced. And then look, on the third point, on the fourth point, it just starts to become a little iffy, right? And now you're starting to crack and now it's resistance. Now it's back above as support, right? It's just really chopping around that moving average. But you can see how It ripped, pulled back for the first time, nail an entry, ripped, pulled back to the second time. You could have made your entry for the leg up. Third pullback, it cracks and it starts trending lower. So again, if you're writing stuff down, which you should be, 9 EMA, right? Strategies. The first pullback is 80-20 odds. So when you see a stock really break on out and rip to the upside on good volume, it's a healthy breakout and it's overextended from the 9 EMA, and it starts to pull back, I have 80-20 odds that the 9 EMA is going to hold as support and I could look to get that next leg up. On the second pullback, I have less odds of being right, but they're still good odds. They're not 80-20 odds. They're like 70-30 odds, maybe 60-40 odds. So I still have high probabilities of being right versus wrong, but it is still a little bit on the riskier side. The third touch of the 9 EMA is all 50-50. The third one, the fourth one, the fifth one, the sixth one, doesn't matter. Anything after the second pullback to the 9 EMA, my probabilities are 50-50. I want high probabilities. So you know what? I will not trade a 9 EMA pullback on number 3, 4, 5, 6, 7, 8, so on and so forth, right? That could be a rule. Only trade the first and the second 9 EMA pullback, the ones that have higher probabilities of actually working on out. All right, guys? So we know what SMAs are. We're using SMAs on the daily, right? We know EMAs. We're using EMAs intraday. We know that we could see a 9 EMA VWAP squeeze. Kapoo! The stock rips. The 9 EMA and the 20 EMA crossing back above the VWAP to the upside is considered bullish. The 9 EMA and the 20 EMA crossing below the VWAP is considered bearish. Traders look at that as, oh, we're probably going to trend lower now. Or, hey, we're probably going to trend higher now because you have those two shorter term moving averages crossing back above the weighted volume average price, the volume weighted average price, the VWAP. Okay, so that's some things that traders look at and they're mindful of. And then you know that you have a 9 EMA pullback, and you can do the same thing, the 20 EMA pullback. Why do I not use a 20 EMA? Because I feel like I just have too much stuff on my chart, right? 2 indicators is enough. 3 indicators with the Bollinger Bands, I mean, it's just too much. It's too much mess on my chart. So I only use the 9 EMA. It's not that the 20 EMA is bad. It's just I don't need the 20 EMA to make consistent profits in the market. This is where it comes to determining and identifying your edge, right? Throwing a 20 EMA up on your chart for a week, for 2 weeks, and looking at how it's respected and look at how it's honored. And if you're like, you know what, Josh, I love the first pullback to the 9 EMA. I love the first pullback to the 20 EMA, right? I have 80% win rate with that, right? Just buying on the first pullback to both. That could be your edge. That could be something that works out great for you. So there's nothing wrong with using a 20 EMA. If you're wondering, like, okay, why are you not using it? I just don't like too much mess on my chart. I'm a support, resistance, trend line, Fibonacci retracement kind of guy, and I love using the VWAP and I love using the 9 EMA. Anything more than that, I feel like I'm just getting confused. I'm getting overwhelmed. There's just too much on my chart, and it takes away from me actually looking at the patterns, the candlestick formations, right? Price action. There's just too much going on, too much confliction, in my opinion. You need 3 to 4 separate reasons to take a trade, ideally. How can I do that? Support resistance, trends, fibs, right? The 9 EMA, the VWAP, the RSI, volume. I have 7 different indicators, right? 7 different forms of technical analysis that I can pull 3 separate reasons to take a trade out of. So I don't need a million indicators to find 3 separate reasons to take a trade. I'm using the ones that I like, the ones that are the most popular, and the ones that I know how to use, right? So again, that's where these lessons come into play, is you knowing the difference between an SMA and an EMA. You know what traders look at with SMAs and EMAs, right? And what they do when the stock's price comes down to a certain level, right? They utilize it as a moving level of support and resistance, and how certain indications with crosses definitely lean traders more to one side with, okay, it looks bullish, we can definitely trend higher, or hey, the 9 EMA is crossing below the VWAP, that can be considered bearish. Maybe I don't look to take any long positions, right? Because we'll probably downtrend for the rest of the day, right? So if any of this is going too fast, I tried to repeat myself 2 to 3 times in case you're just tuning in. Maybe sometimes I talk fast. Again, I like to repeat myself just to make sure that I'm getting that information across. All right. So SMAs and EMAs, what time frames we use them on, why we use them on those time frames, right? And how we use them on those time frames. Now I want to end the SMA EMA lesson with some terms that you probably heard before and what they mean? So everybody, probably, maybe not everybody, has heard these terms. Death cross and golden cross. How many times have you heard the term death cross and golden cross? Right? We heard it a lot last year during the pandemic. We heard it a lot last year. You hear it a lot with people talking about cryptocurrency and Bitcoin, right? So let's talk about the death cross. Ooh, you already know what that means. The death cross. That means bad, right? You would just assume that the death cross is bad. Well, it is bad. So the death cross is a technical chart pattern indicating the potential for a major sell-off. The death cross, the death cloth. Oh, Josh, the death cloth. Okay. The death cross appears on a chart when a stock's short-term moving average crosses below its long-term moving average. The most common moving averages used in this pattern are the 50-day and the 200-day. So basically, when the 50-day crosses below the 200-day, that's an indication to investors of, oh crap, we could be selling off really aggressively coming on up. Let's go look at the SPY last year. Go look at the SPY. I remember them talking about death cross. Oh my gosh, we're going to dump another 20%. It's a lagging indicator, number one, and it's not something you solely rely on. It's a good indication. It's something to be mindful of, but it's not a sole indicator of I'm going to short the crap out of the SPY because I saw a death cross. Because if you would have done that last year, you would have been burned. All right? Now look, right here. Let's say you're watching the SPY. Oh, the death cross. CNBC's talking about the death cross. Oh my gosh. Oh my, I'm going to have to short the crap out of everything. I'm shorting it. Let's see what would have happened when you saw a death cross on the SPY. What day did we see a death cross? Right there. You see a death cross. And everybody's freaking out. Oh my gosh. The SPY just crossed the death cross. Oh no. Oh, that means the market's going to sell off. I can't tell you how many people were probably buying a crap load of puts on the SPY, thinking that, oh, it's a death cross. It's a definitive that we start selling off. Look what happens on the SPY. You get the death cross. People are panicking. People are fearful. The market's still selling off. Oh, it dumps a little bit. And look at that. Right away, starts grinding right back up. So look at that. Like you nail a put. Maybe you got a couple days of profit, but imagine thinking like, oh, the death cross, we're going to continue to see this dump and dump and dump. Right? No. Death cross happened. The stock had a temporary pullback, bottomed, and then continued to grind after that and never looked back. Never looked back. And then you have the same thing, right? So it's when the 50 SMA crosses below the 200, that is a strong sign of market bearishness. Be concerned. Be fearful, right? Don't buy. Short, all right? It's something to be mindful of. When you see that cross, it's definitely something to be mindful of because it is an indication that you could see a massive sell-off coming. And then the same thing with a golden cross, right? So what's a golden cross? It's the complete opposite. The golden cross is a chart pattern in which a relatively short-term moving average crosses above the long-term moving average. The golden cross is a bullish breakout pattern formed from a crossover involving a security's short-term moving average, such as a 15-day moving average, breaking above its long-term moving average, such as a 50-day. We still utilize the same concept. The most popular is the 50-day and the 200. So I don't know why they're talking about a 15 and a 50 here, but they give you an example of a 50-day and a 200-day. That doesn't make any sense to me. You're going to say the 15-day moving average crossing the 50, but give an example of the 50 crossing the 200. Makes no sense. But when we're looking at death crosses and golden crosses, right, we're usually applying the 50-day crossing above or below the 200-day. So the death cross is the 50-day crossing below. The golden cross is the 50-day crossing above. And we can go back here and look at the SPY, right? So we saw the death cross. Nothing happened. It actually grinded higher. And then we come into where we see the 50 crossing the 200. And that's called a golden cross. And look at the SPY since then. Look at the SPY since then. Imagine saying, hey, we just had a nice little golden cross, right? I'm going to buy the SPY. I'm going to buy this bad boy right around here. right around 324. That's where I'm in, right? It came back down. That level, 324, bounced, and hasn't looked back since. So again, it could be a great indication, guys. It could be definitely something to be mindful of. If you see the golden cross and you see the stock ripping and you're missing the run, you can wait for a pullback. Look, it pulled back, bounced, pulled back, bounced, started to move on higher. So again, we know what a golden cross is. It's when the 50 days crossing the 200 to the upside. We know what a death cross is. It's when the 50 days crossing the 200 to the downside. And it's something to be mindful of. It's not an indication of go short or go long. It's not. You use multiple forms of technical analysis, but it can definitely help give you an edge. Other traders see these crosses. Other traders react to these crosses. And it could definitely help support your edge of being on the right side of the trade. So anytime you come across a stock that you're looking at, looking like the 50 is going to cross the 200, right? It could be a great indication of, hey, I'm thinking more long. I'm thinking going long on the stock, right? You're more long biased, but still waiting for that long opportunity to present itself. Or you see the 50 crossing below the 200, thinking, I'm more short. If I get a good short setup, I'm thinking more to the short side because we do have that cross, and other traders are looking at possibly selling the stock selling off as well, maybe shorting it. Right? It maybe help increase your odds and increase your edge on being on the right side of the trade. Right? So, I hear golden child a lot when people talk about me. I've heard golden child. I've heard the golden year. Right? Your golden year is when you turn your age on your birthday. So, like, I turned 25 on the 25th. I guess that was my golden year. My wife turned 22 on the 22nd. That was her golden year. I guess people don't have golden years in their 30s, right? I don't know. I turned 35 on the, oh, damn it. Oh, man, nope. I turned 22 on the, oh, damn it. Alpha is the golden child. I appreciate that. I'll take that compliment. I'll take it. So, guys and girls, you know, that was about a 37-minute long lesson. I like to be as thorough as possible. Now, a lot of you probably already know what SMAs and EMAs are and why we use them. We talk about a lot of this each and every day. But for the purpose of the Small Account Challenge, I want to keep these lessons structured as if 3 weeks ago, we have someone come to chat that knows absolutely nothing about stocks. And now we're slowly taking them through step by step on what a lot of these things mean, why we use them, terms and terminology, just to get you that much more education to where what you do now. You can start applying these things. Start applying the SMAs and the EMAs, looking for different strategies and approaches behind utilizing these forms of technical analysis to help give you higher probabilities of being right in the market. And now you have the opportunity to say, hey, I learned something new today, Josh. I didn't know that about SMAs. I didn't know there was a golden cross or a death cross. Right? I learned something new today. Awesome. Or hey, I didn't know you could trade the 9 EMA pullback as a standalone. The only reason you can do that is because there's a lot of other people that do it as well, which supports the bounce off the 9 EMA intraday, right? But don't touch it on 0.3456 because it gets risky. So I learned something today. Or hey, I still have questions. I'm kind of confused. Can you reiterate something for me? So now's a great opportunity to go ahead and ask those questions. Do we have any questions, comments, or concerns in regards to SMAs, EMAs, or the types of setups, right? The types of patterns that you can see form with SMAs and EMAs.